This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Patrick, I want to get on now to our post-game chart deck. Listeners, you know you normally can find the download link in your Research Roundup email. That Research Roundup email, we hope to get to you just as soon as we can. We're having a technical problem. If you need to get to it, you can just log in to the website at macrovoices.com. Use the same username and password that you're registered with when you first set up your account. You'll be able to find all that content that's supposed to be in Research Roundup right there on the website. And the Research Roundup email will go out just as soon as we can get our bulk email system fixed, hopefully not too long after this episode airs. Patrick, the chart deck is called Talking Charts. Let's talk charts.
All right. Well, I just wanted to first start off with some reference to the S&P 500. And obviously, we started the day with a pretty big red candle. We've been able to retrace at least half of the early losses and ask the question as to whether we're beginning some sort of market correction. And I think the first thing I want to really address is that market corrections happen. And it's not about being super bearish or that the market has to go through a COVID-style market crash and a 20-30% wipeout, but very commonly the stock markets will have these 5 to 10% market corrections in the process of trading. And so we're simply identifying the different cycles that we're in. The way I kind of perceive it is that this market is a little bit overdone and the market breadth is actually deteriorating, and the stocks that were the leadership, which are the FANG stocks, and I know the acronym of FANG doesn't include Microsoft, but really we're just talking about these big growth companies that are the big behemoths in the NASDAQ, have truly been the leadership, and they still continue to be. Like even with today's down day, Amazon was still at new highs, and Apple and Microsoft both holding, all of them are holding near their highs. And we haven't seen them yet begin the correction. But in my mind, we are in the summer doldrums, and it's very likely that we're going to see some sort of mean reverting correction from this impulse higher, simply because there isn't enough momentum in the broader markets to keep this going. So it'd be interesting. I put on a 50-day moving average just to give an idea of where all the corrections throughout the year have initially found support. But what is interesting is that when we get into a more meaningful market correction, often we spend some prolonged period, such as several weeks, below the 50-day moving average in a correction. And it'll be really interesting to see whether the sell-off that began here today, whether this is the beginning of one of these corrections that will create sort of a summer consolidation period in the markets. And this is one of those interesting turn points where something like this can happen. So we're going to be watching to see whether this follows through. I think one of the key levels to watch is what happens below 4,300 on the S&P. If we see that really does kind of leave it quite wide open for us to head down to that 50-day moving average for a test. So that's what's going to be on my mind going into next week.
Now, looking on page 3 at the dollar index, you're the technician in the house, Patrick. I have to ask, is that, would you interpret this as a double bottom that potentially, I'm just looking at this chart, we got a bottom there right at the beginning of 2021. We got about the same bottom in the middle of May or beginning of June, and now we're above that 50-day moving average and seems to be staying there. Is this bottoms in, or what do you think?
Well, it's beyond even a double bottom. This kind of 89.90 level is actually the bottom end of that 5-year range on the dollar index. And just because that bottom support of the trade range is held does not necessarily imply that there's a new U.S. dollar bull market. Rather, that the bear market in the U.S. dollar simply wasn't strong enough to be taking the dollar to all-time new lows, or at least decade lows. And so so what we're watching here is simply now that the dollar has rebounded, where is it heading on the short term in terms of the upper boundaries of resistance? Throughout the last 6 months, the dollar index found some overhead resistance in this kind of 93 to 95 zone. So I think the dollar can continue to remain in its upward movement towards some of these overhead resistance levels, but I think it's a little premature to be already calling it, let's say, a new US dollar bull phase. I think it's simply more like a ping pong match where the dollar index found some key support underneath and is heading to test the top end of the range.
Patrick, I couldn't agree more with your analysis. I don't think it's at all clear what the real direction of the dollar is because I don't think that the interpretation of monetary policy is uniform yet. Let's move on to page 4, though. Bloomberg Commodity Index Futures. Boy, looking at this chart, seems like we're beginning some kind of consolidation or at least a pause in the ferocious rally. What's going on here?
Right. And so if we go back and take it from a perspective that really since the start of the year, the US dollar bear stopped declining and started basing. And at the same time, the commodities, since that November reflation trade kicked in, had an extraordinary run on the upside. And what we've seen is as those really hot inflation prints started coming in over the last couple months, it actually surprisingly corresponded with commodities sort of hitting a lot of their short-term peaks. But what is interesting is the Bloomberg Commodity Index, because it's so heavily weighted toward the energy basket, has really continued to hold up very much along its highs. And to kind of illustrate, obviously we're seeing a bit of resistance and consolidation in there. But when we look on page 5 on that actual crude oil chart, we can see what's really been the tailwind behind holding that commodity index higher, which is that crude oil kept plugging upwards toward that 77 level. And like you were suggesting, there is no evidence that a new downtrend in any way is underway. Often these types of dips in crude oil would be bought, and we're going to be approaching some interesting support levels where as we kind of get towards $70, that may end up actually being bought on dip. And so watching what happens next on crude oil is going to be a really important tell what is going to play out in that broader commodity index. And I think the way to best illustrate that is to look on page 6, where what I did was in the black line have the commodity index that we were just talking about overlaid with lumber, and I just chose one of the grains, in this case the soybean and like copper, just to represent some of the industrial metals. And what we really have seen is that it was in the early May that we saw peaks in all of these other commodities. And we are now going slowly on to 2 months of actual commodity consolidation outside of the energy space. And this is a really interesting divergence. Usually, crude oil really is kind of marching to the beat of its own drum here. And it'll be really interesting to see what happens next in crude, because really there is nothing holding the commodity index up outside of crude. And that really may set in motion a much broader commodity correction that can last much longer if for whatever reason crude oil did follow through on its selling. So that's one of the most important things to watch is, will crude oil be bought on dip? I know you believe it will be, but I certainly think it's the most important thing to watch here going into next week.
Patrick, I want to go back to your lumber chart just because this one's near and dear to my heart. I've been watching lumber futures, not because I trade them, but because I want to build a house. And I've been very concerned that the cost of all construction is just crazy through the roof with this panic reaction to all kinds of people in cities moving out and buying houses in the country and so forth. I look at this chart and I say, it looks to me like this lumber price deviation is probably over, and maybe planning to build a house in the next couple of years is not such a bad idea. What do you think?
Well, you know what? I mean, the multi-decade range for lumber was down in the $200 to even $500 range. And so lumber went parabolic to $1,700 on the upside, and we're back down to under $800. We still are more than double the kind of decade trade range. And so while I think we've seen a point where lumber is incredibly oversold, it'll be really interesting to see whether or not it still weakens a little bit from here. But we've certainly seen that short-term supply shock that seemed to drive that parabolic rise has now been kind of worked through the system. We're starting to approach the kind of more reasonable prices. Even, I don't know whether anticipating lumber to return back to 2019 and 20 prices is realistic anymore, but certainly approaching the ranges where that excess has been really worked out of the price.
Well, this really goes back to Victor's comment then, doesn't it? Because if you've got Victor's view, which is that this is a pendulum swung too far and is about to return, then really we can expect cost of construction and building materials and all that stuff to come back down on the deflationary theme that Victor's told us about. If I'm right in that we're at the beginning of a big 1970s size secular inflation, right now is the buy the dip moment on building anything because prices are about to get a whole lot higher in the next decade or so. So I guess it's a toss-up. Let's keep going, though, and continue on to page 7 and everybody's favorite market, which is gold. Just looks like kissing the 50-day from the bottom side. What do you make of this?
Right. It's interesting because we talked about how gold has kind of bounced and worked its way toward this 1800 level, still not in any uptrend by any means. Obviously, that big Fed hawkish tilt really took the wind out of the sails of gold. But what is interesting is we've had many, many guests come on to MacroVoices talk about the correlation of gold to real yields. And one of the interesting observations on page 8 to make is that real yields on the 10-year treasuries have actually returned to being very close to minus 1% again. And all of that little scare that happened earlier several months ago that spooked the gold market in the first place has been almost entirely reversed. And it'll be really interesting to see whether these negative real yields stay down here and whether gold finally actually stays within its correlation and bullishly responds to that. And with real yields down where they are, it'll be really interesting to see whether gold can beat above these moving averages and get back to like 1850 plus, where the price action will start to turn more bullish here.
Patrick, let's move on to the 10-year Treasury yield, not the real yield, but the nominal yield on page 9.
Right, and so we were talking about in the market wrap and just how that 1.50 on the rates finally gave out, and we really see a bond rally underway as rates are just starting to break down. But what is noteworthy and what I really wanted to highlight is going beyond the U.S. yields, because is this a bigger global trend? And is this something that is being almost a disinflationary sign that is happening globally? And so on page 10, I have that German Bund, and what we see is that while throughout much of the year we went from almost minus 70 basis points on the German 10-year to almost going back to zero, and here we are back to minus 30 basis points, and that German bond yields once again rolling right back down. And we take a look at the Japanese 10-year yield, which was near zero at the start of the year, had that quick jump to 20 basis points in the early first few months of the year, and we're right back down to zero. Point being here is that kind of bond bear that reared its head in the last 6 months, it really is showing that right around the world, yields are declining. And I kind of asked the question: is that pendulum swing that Victor talked about? Are we seeing the signs on a global basis that the pendulum just started to swing the other way, and that the reflation trade, in fact, has played itself out? And I think that's one of the big puzzle pieces to solve here in the coming weeks.
And listeners, you can get Patrick's chart decks not just once a week, but every day when you sign up for a free trial of Patrick's service, Big Picture Trading. You can find the information on page 12 of the chart deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.